Ladies and gentlemen, please welcome to the stage moderator of our next panel, David Levenfeld.
Greetings, everybody. My name is David Levenfeld. Greetings, everybody. I am the co-founder and CEO of Storage Pros Management, a company I co-founded with Ian Bernstein in 2007. Before introducing our esteemed panelists, what I'd like to do is thank I'm hearing an echo, and Michael, if you could get that to stop, I'd appreciate it. Before getting started with the panel, I'd like to thank Ian and Janice and Allison and Jessica and Dave, who do the heavy listing with SBOA and list self-storage every day and are responsible for the conference today. And without further ado, I'm going to introduce our panelists, starting bottom left with Scott Levy. He is currently the Vice President of Investments with CubeSmart and has held that role since November of 2011. Since joining the company, Scott has been involved in more than $4 billion of self-storage transactions. He joined CubeSmart in 2006 and has held various roles in the corporate finance, asset management, and investment functions. Scott has over 18 years of commercial real estate experience, including 13 in the self-storage industry. Next, Ben Vestal. Ben has been involved in the management, development, and brokerage of commercial real estate for the last 20 years, including more than $1 billion of self-storage investment sales transactions. In 2006, Ben acquired an ownership interest in the Argus Self-Storage Advisors brokerage network. And in 2009, Ben became the president and CEO of Argus, which is comprised of 37 broker affiliates covering more than 40 markets nationwide. Next is Aaron Swerdlin. Aaron serves as a vice chairman of Newmark Knight Frank in the Houston office. Aaron has more than 25 years of capital markets experience and serves as the firm's national practice leader for the self-storage sector. To date, Aaron has led more than $8 billion in overall transaction volume, and his transactions have included single asset portfolio sales, portfolio recapitalizations, and regional portfolio dispositions, some of which are among the most significant ever completed in the self-storage industry. Mr. Swerdlin's experience encompasses several hundred transactions, more than 775 properties, and in excess of 55 million square feet of storage space. Finally, Brian Cohen. Brian is the founder and president of Andover Properties, LLC, an investor, owner, operator, and developer of real estate throughout the East Coast, based in Manhattan. The firm focuses on the acquisition, development, management, and sales of industrial, retail, and self-storage properties. Its investors and partners include global institutional real estate private equity funds and high net worth individuals. Since founding Andover in 2003, Brian has led the acquisition of self-storage assets totaling more than 4 million rentable square feet. The firm currently owns and manages 40 self-storage facilities in 12 states. Andover Properties operates its facilities under the Storage King USA brand. And with that, I just have one caveat, which is we're going to refer in a blanket fashion to the interrelated economic and health crises as COVID. and everything else will be self-storage language that is known to you. And I will kick off the questions by directing this one to Aaron. Aaron, under the assumption that most, if not all, buyers essentially disappeared as we went into lockdown in March, what category of buyers are emerging early in the reopening process, and which buyers are poised to join them soon, and who remains on the sidelines?
I probably would challenge the assumption that all buyers essentially disappeared. I mean, I think what we observed, first of all, we had a handful of transactions that have closed since most of the lockdowns have been in place. So they certainly didn't disappear. I think we closed nearly $200 million worth of business the last 2 weeks of March. I think that while no one disappeared, the challenge was what's going to happen to April collections. And when April collections, kind of manifest to a pretty positive outcome, then the concern was, okay, well, do we have, kind of phantom occupancy or accrued occupancy that's going to move out as soon as mobility returns? And so that was the concern for May. That abated pretty early into May, and given that the industry is 40 to 60% on anniversary date, not first of the month, we even had an early look into May, halfway through April. So I think those concerns began to abate. And I think the final concern was, are we going to be able to get any sort of leasing season, rental rate increases on existing tenants, what have you? And a lot of those letters started going out in May as the stay-at-home orders began to be lifted. And I think that the outcome of that has so far been very positive. We haven't seen outsized move-outs. I think pretty much across the board, the groups that we've polled have said that move-outs remain down anywhere from 20 to 25% year over year, and move-ins are approaching kind of year over year same levels as last June. So I think what it's done is there's a ton of capital that wants into the space. I think a majority of the focus is on stabilized assets or near stabilized assets. Cash flow is certainly critical. I'm sure we'll touch on lease up later, so I don't want to go off on that tangent. But I think that most buyers that have remained active or who are ready to be, as acquisitive as they were on March 1st for the balance of the year, are probably the buyers that are largely focused on, either in-place yield or year one yield. And I think the signs are based on our inbound activity for BOV requests and the inbound calls we get from buyers who looked at stuff that we had in the market or knew about stuff we had that was coming to market. That they are absolutely ready to be transactional. I think probably largely psychological, but I think they're using July 4th as a pivot point and also using that as a way to kind of confirm June performance, which I think we all have already seen what June's going to turn out to be, unless we just have massive move outs the last weekend of June, which no signs that that's going to happen. I think we see most of the buyers that were very active on cash flowing or near stabilized deals before all this happened, returning to, essentially normal levels. I think the impacts will be on, where's the debt market, where coupons I don't think anybody's return on equity targets change, but their ability to hit those targets based on leverage and any deterioration of NOI is going to have an impact there. But I think we're largely optimistic that as the second half of the year progresses, it'll feel a whole lot more like the first quarter than it did the second quarter.
Thank you, Aaron. Moving on to Brian. Brian, your portfolio is diverse and includes properties in primary, secondary, and tertiary markets. Are you back at it as a buyer at this point? And if not, what will trigger your re-entry into the market?
Thanks, David. Hopefully you can hear me, because on your end it's very scratchy. But we never left the market. Since COVID has started, we've signed up 9 new deals and we've closed 3, one of which we closed yesterday in Denver, and last week we closed Titusville, Florida, a week before in Akron, Ohio. So we're looking in all markets, and we continue to be a buyer.
Okay. That's very interesting and is at odds with what I've heard about most buyers, but that probably presents you with quite a bit of opportunity. Scott, your shop
That's
at
what we're hoping for.
Your shop at CubeSmart underwrites a lot of Class A major metro properties. Where are you now in terms of re-entering the market? And perhaps more importantly, how will your underwriting approach change from the way it was pre-COVID?
Thanks, David, and thanks for having me on. We've remained pretty busy throughout the whole downturn. We've certainly been underwriting our fair share and then some of assets. We certainly see a change in asset quality. I feel a little bit, Aaron touched on this a bit. It does feel like the market's a little bit on hold. I think nobody wants to be first and everybody wants to be second. So we're just waiting to see a couple deals break through. I think the deal that Brian mentioned he closed yesterday is great. I think that hopefully we'll, as we see more, it'll create more deal flow. And I think the things will be back to what Aaron was saying for the second half of the year. Thinking about how we underwrite, we've always remained pretty consistent in how we underwrite. I mean, before any of this pre-COVID started, we saw a lot as far as fundamentals slowing down in the industry as new supply seems to hit almost every single submarket that everybody's in, and it feels like COVID hasn't made that certainly any easier. So we're remaining disciplined. I think short term, we're certainly mindful of how the things again that Aaron had mentioned as far as holding off on auctions and really just pausing the way everyone normally operates the business has on properties, and we've certainly seen it in our portfolio as well. I think longer term, we're not fully sure what this is going to mean for the customer yet, and we're fortunate we have a lot of data that we can try and watch. But how do we change operationally to be able to make stores more appealing to customers that certainly have concerns regarding contact and social distancing? We've implemented a no-touch rental process. So there's a lot of that we're factoring into our underwriting. But in general, I don't think that we've done anything too materially different, just been a lot more mindful of how we're doing it and just how hard we really want to push on any one property from an underwriting perspective.
Just as a follow-up, Scott, in my own personal experience, even given some stability throughout this crisis in cap rates and the overall level of buyer interest, even if that interest is on hold, is your underwriting adjusted by the fact that everybody's NOI is impacted in some way by what's been going on the last few months, so that year over years aren't as robust as one might have hoped when sellers position initially putting stuff out on the market?
Yeah, I think you're seeing a lot of you're certainly seeing a lot of noise in 2020 numbers, especially when you're comparing to 2019. And it's for a multitude of reasons. Again, I think a lot of it at this point is that you don't know fully. If you look at a property right now, you don't fully know what that property looks like, especially depending on the market and where some of these stay-at-home orders were lifted. How much fool's gold occupancy is there, where you have customers that should have been auctioned off in March or in April and just hasn't been done yet. So I think that, again, part of that, and Aaron had mentioned it, I hate to keep giving him credit for anything, but a lot of it is there's a little bit of a wait and see just to let all of this work itself out. I think that, David, NOI growth was going to be challenging in 2020. I think all the public companies said that in some form or fashion, and a lot of that has to do with pressure on revenue because of new supply. And it isn't like expenses are finding a whole lot of savings. We've done a lot of that already. We'll talk about, I'm sure, taxes a little bit later because it's one of the largest expense items that's front of mind on everybody. But it's become increasingly difficult, especially as it has been in previous years, to try and forecast where you think NOI is going to be. And even so, you can say that the starting point, which is normally where we start with, is a little bit more opaque as well.
Since Scott's agreeing with everything I'm saying, I'll add that I think there's certainly validity to where are we with auctions, but everyone can look at their ARs to determine what their maximum exposure to auction or phantom occupancy or what have you is. And from all the data we've seen on the properties we're actually underwriting and from the discussions we're having with owners, ARs are just not up materially. Either June over June, year to date over year to date. I mean, you would know what your exposure is, and it just doesn't seem like there's outsized exposure. If there's a remaining question, are there people that are going to move out when they feel a little bit more free to move around? But it kind of feels like most of the country is moving enough that if that was going to happen, we probably would have seen it this month.
And a follow up with that also, when you're thinking about forecasting going forward, is how much does when all this PPP money runs out and additional unemployment benefits end in July, that extra $600 a month, does that become the tipping point where the customer had said, I have that money, I can use it for my storage bill, but now when I'm not getting that check, I can't? And do we see anything from that? We don't. Again, you just don't have a full impact yet for how many customers are actually using that money to pay the storage bill. But I can tell you, we've been tracking collections almost daily. And when the initial round of stimulus checks came out, we did see a material move in delinquencies go down because we believe that stimulus checks were being used to pay the storage bill.
That's a very good point. And, the impact on disposable income of what will or won't happen when the initial round of stimulus wears off will be very interesting.
Yeah, we have 40 million people that are unemployed right now. I got to imagine at least one or two of those are using self-storage.
Yes, I think it's two. Ben,
Yes.
welcome.
How are you?
So I'm trying to drill down to what market activity is, and I'm curious about the pace of properties hitting the market through the Argus network since the crisis began. I know that at List Self-Storage, we've been pleasantly surprised by the robust listing activity, which has kind of continued unabated throughout the crisis. And I'm wondering what your experience has been.
David, I kind of think I agree with most of what Scott and Aaron said, in the fact that, there's just not enough data points out there to set pricing today. But much like your experience at List Self-Storage, we are seeing an uptick in listing activity. I believe, I prepared a little bit for the call, and I believe we've seen 30 or 40 new listings in the last 90 days at the Argus network, albeit the size of the deals are in the $1 to $5 million range mainly. We feel that the institutional or larger operators and owners today are certainly waiting and seeing more so than maybe the individual owner today. I believe if you went back and looked at your List Self-Storage listings, my intuition would tell me that most of the new listings that you're getting are individuals that own 1 to 2 properties and in that $5 to $6 million range, typically, maybe even a little smaller than that. As I think what the pandemic did in the lockdown for a lot of those folks was it really brought some life events to the head. Whether it's desire to retire or whatever it is. I think that they, we see about 80% of our listings come from life events, not because of all-time high pricing value. And I think that during the pandemic, there was a lot of family time. There was a lot of uncertainty in the market. And I think it really brought to the forefront a lot of, individual owners, desire to retire, or that life event. So I think, we're seeing a lot of those listings come to market. I will say with regards to pricing, it's really hard to price. We kind of gave them a pre-COVID pricing metrics and then expanded it with a pretty wide range, a much wider range than we typically would when we're valuing assets and taking them to market. However, I will tell you, transaction velocity has been very brisk over the last, 60 days. It seems like people are getting back to normal. I'll give Brian some credit. We sold him the deal in Denver yesterday, and he performed, right on schedule and without any hiccups. So I think there's a lot of buyers like Brian out there today. And like Aaron said, there's a lot of equity looking to be placed into the market that, they see this as an opportune time. I'm sure we'll talk about pricing later on the call, but, I do think there's been some minor adjustments and some, deal point adjustments with regards to due diligence and inspection times, but we're actually seeing those come back in over the last couple of weeks. So, delightfully surprised with a lot of new listings, and hopefully they're priced appropriately, because I don't think there's been enough data points to really set pricing yet.
Scott, Has your acquisition targeting changed since the crisis set in terms of types of property and location target markets?
In general, no. I mean, from a target market perspective, we're still focused on top 40 MSAs and in areas where we can grow our footprint and increase the platform of our portfolio. When you think about types of assets for us, I mean, we're relatively market agnostic to climate control, multi-story versus single story. It all depends on what the customer wants and where we think we can really drive results based upon implementation of our platform. We're still shying away or shying closer towards investment grade properties versus not. So the unpaved drive aisles and the lack of indoor plumbing are properties that we usually pass on.
Aaron, what has been the effect of the crisis on the value of lease-up properties, those that have been developed recently and are still being leased up? And is pressure increasing on developers to sell those properties at pricing reflecting diminished expectations?
I mean, we haven't seen anything come to market. We haven't brought anything to market since March 15th that was 30% occupied, and we just haven't seen anything like that clear. So I don't know that we know exactly where pricing is on that. I will say that anecdotally, street rates don't matter as much to a stabilized operator. They have now even less, but in a normal market where you've got 30 to 50 move-ins and move-outs a month, I mean, you're not turning over more than 7 or 8% of your facility in any given month. So street rates really don't have a huge impact. But at the same time, street rates are everything to somebody that's 30% occupied, that doesn't have 7 or 8 cohorts of tenants that they've got on a ECRI program, and they're really living and dying by street rates. And as we all know, the street rate market has changed drastically over the last 2 to 3 leasing seasons. Some markets down as much as 30%. So I think the lease up environment overall has been hardest hit, not only by the last 3.5 to 4 months, but really by the last 2 to 3 leasing seasons. And like Scott said, it's tough enough to underwrite where NOI is going to be a year from now or 2 years from now. I mean, imagine doing that with a property that's 35% occupied, that's achieving $9 rents in a market that 3 years ago had $16 street rates. Not to say that in-place rents aren't closer to the 16 than they are to the 9, but you don't know where you're going to stabilize. You don't know where you're going to get leasing traction on a stabilized basis. And I mean, I think the unknown just makes it really hard to be aggressive. I think the challenge from trying to create transactions out of that is that a lot of the developers are experiencing a 2x pace of square footage absorption. So from a revenue standpoint at the moment, they're really not too far off their original pro forma, if off at all. So to answer your question about challenges or diminished expectations, I mean, not yet, because even though at 60% occupancy, they'll produce what they thought they were going to produce at 40% occupancy, they haven't breached covenants with lenders. They're not having to enhance covenants or increase reserves with their construction lender. So I think until they start to feel those sorts of pressures, there's just not pressure to not kind of let it ride and continue to try to find a positive outcome. I know that a lot of the deals that we valued, I think we thought where we were was probably a pretty strong single or maybe a stretch double for the developer. So they're still making money, but they're still looking for a home run. And I guess the question will be, is there slack in that? And by the time they realize they're not going to hit the home run, is that single still going to be there, or is there going to be some pain? I don't know. I think a lot of the development that's taken place over the last couple of years has been with institutional capital. They got a lot of staying power, probably have no desire to walk away from the real equity they have in deals, because as we all know, construction loans weren't, you had real capital in any development deal you did, whether you were doing 6 or 10 with an institutional partner or 1 on your own. And you had on a $10 million cost deal, you had $2.5 to $3.5 million in the deal. You're not walking away from that. The institutional capital probably loses some of the attention of their partner, because at that point they're only working for fees. The likelihood that they hit their IRR waterfalls and have any kind of outsized promote. It's probably diminished, but I think we're just in that period where we figure out how much slack there is and how much of that slack is absorbed by a more robust leasing season. We were certainly headed in that direction before COVID. We saw signs that some of the public companies who tend to be very aggressive with rates in the wintertime and really materially drop rates. We noticed that they held their summer rates last year past Labor Day a couple of weeks longer than they had in the previous couple of years. And we started to see spring rental rates hit before March 1st, which is also something we haven't seen the last couple of years. So I think the signs were there that we were going to have a very strong leasing season. And my partner, Kenneth, who likes to say, we're going to have a leasing season. The question is it going to be 5 months long and just start late? Is it going to be 2 weeks long and start in August? I mean, we don't know what the leasing, that peak leasing season, the premium rental rates that are sometimes as much as 20% over your annual average rental rate. I mean, how much of that are we going to have? And I think that's going to drive a lot of the second part of your question, the answer to the second part of your question, because I just don't think we know yet. I do think it's pretty difficult to take a lease up deal or a lease up portfolio to market and expect that you're going to get anywhere close to pre-COVID pricing.
I'd add something to that, Aaron. One thing that we've seen, at least here in Denver, where we saw a lot of new supply, we've seen this COVID disruption really give some of the developers that were really struggling some additional time, right? I mean, the bank now has an excuse and a real valid situation to talk to their investment committee about whether it's asking for forbearance on the loan or extending some IO. But we've seen 4 or 5 situations here in Denver where I think, the rubber was really going to meet the road at the end of this leasing season, where I think that's been extended maybe 60, 90, maybe even 120, 180 days with regards to COVID. So I actually think it's helped some of the folks that had deals that were really struggling, that were in lease up. I think that their banks are becoming more flexible due to the COVID disruption, is what we've seen here in Denver over the last, 90 days.
Yeah, I mean, I definitely think you're going to have some sins in this with some of the construction loans, and maybe you buy the time you need. I think one of the other things people talk about are we going to see some of the development headwinds or the new supply headwinds abate and folks walk away from deals. And I do think in certain markets that really were inundated with new competition, some of the Carolina markets, North Dallas, some of the places where it's almost that same effect, man, where you were kind of looking for an excuse to walk away from the deal. I mean, this is your excuse. Yeah. But we're also hearing that in some of the other markets that the capital is saying, hey, look, by the time I put a shovel in the ground today, by the time I'm renting units 12, 14, 16 months from now, we're going to be through this. The market should be stabilized. And I don't think it's going to be the death sentence to new supply that we all would like for it to be. But I do think you're going to see, especially in the really hard hit markets, that this is at least going to be a 2 to 3 year pause on, any more material new competition.
Totally agree with that.
Okay, Brian, can you hear me?
Yes, I haven't heard anything up until now, but now I can hear you.
I seem to have that power. Brian.
So whatever I say will probably contradict everybody, but.
Well, Brian, you can just answer anything. If you can't hear the question, you can just say whatever you'd like, but I'll try the question. As an active buyer with access to capital, are you seeing crisis-driven distress indicating that property values are decreasing, or are you just simply executing on transactions that are essentially priced and structured the way they would have been pre-COVID?
So I think, look, so far we're not seeing any distress on the stable properties. And I think, as Aaron was alluding to before, we are, we're seeing prices fall on some of the lease-up properties, but not to a significant amount. And I think some of those sellers have unrealistic expectations. And I think if you're a seller who can hold for the next 3 years to get through some of the supply glut, you'll be okay. But if you do need to sell in the next 3 years, you're going to have some issues. And just for instance, we get at least once a week, we get a phone call from a mezz lender or hard money lender looking at C of O deals or lease up deals, and they're cutting deals at pretty high rates. So it'll be interesting to see what happens with some of those loans 2 years down the road.
Yeah, especially mezzanine when you've got that high interest carry. Ben, back to you.
Sounds good.
Have you seen sellers adjust at all to a new world in terms of pricing realism when you're taking listings, or are they clinging to pre-COVID expectations?
That's a great question. I think, believe it or not, in the conversations that I've had with prospective sellers recently, most of them are, adjusting pricing expectations somewhat. I don't know if I can quantify that. The best I can see, it's 20 to 30 basis points on the cap rate higher, and that correlates to about 2 to 4% on the purchase price or the transaction price. And I think really the conversations that we're having with sellers today is that they just need to be flexible with regards to the timing of the transaction. It's taken folks a little bit longer. And the debt market's pretty fluid, albeit it has stabilized more over the last 30 days. But, for the first time in my career, I've seen sellers really be open to some sort of price adjustment due to the COVID situation. However, I don't know how long that lasts. I do, most of the deals that we're taking out to market today are stabilized assets. So, if you look historically, these are still very aggressively priced deals for the most part. But I do believe they are being, somewhat flexible. My best assessment is it's 25 to 30 basis points on the cap rate. That doesn't mean we're not going to list it at, kind of that pre-COVID pricing range, but they're open to listening to a wider range of pricing guidance. And that's a direct correlation to the cost of capital and just the difficulty of the debt markets today.
In my experience, I'd like to compliment everybody who's been able to transact during the last few months. In my experience, when there's dislocation in the market is when you get the biggest disconnect between buyers and sellers, because sellers tend to be sentimental and cling to pricing expectations from pre-crisis levels. And buyers are sophisticated enough and have the money before the transaction so that they're not going to pay sentimental prices for current conditions. So the fact, Brian, that you've been able to transact, and Ben, that you're taking listings and that the market is still functioning, I think says a lot about our industry and the desirability of properties. And we seem, as of yet, to be avoiding a good share of the dislocation that characterized the last major crisis in 2008.
Yeah, David,
Okay.
I think a lot of that can be attributed to the revenue management. If you look at the last 8 or 9 quarters, I mean, the REITs have not really reported robust street rate data, yet they're all still producing positive same-store revenue growth. So if the price of your product on the shelf is cheaper, but your revenue is up, it's coming from revenue management. And I think how quickly the industry reacted this time says a lot about how much further along we are in the way we think about not just managing to a square foot occupancy number, but to really focusing on revenue. And I think it's not just the public companies. We've seen that from some of the smaller operators to the largest operators. I think we all wake up every day and thank our lucky stars we're in self-storage, but the industry overall is just so much smarter, and probably has a lot to do with the institutional capital that's found its way into the space over the last 10 years, who've kind of forced and required better financial reporting and better operations and just more rigor across the board. But we're all now benefiting from all of that in a pretty big way, because I don't think had this happened in 2009, if that 2009 had been this sort of crisis, I don't think we'd be seeing the outcome we're seeing now.
To comment a little bit on that, on the storage market, or on the transaction market, I think one of the differences this time during this disruption is, we really had a financial situation in the last disruption, where this disruption was more of like, I don't want to relate it to 9/11, but more of a lifestyle or a society-wide situation. And our transaction velocity is off, maybe 30, 40% over the last 60, 90 days. However, in 08, 09, it was off 70, 80%. So, we are seeing less folks transacting, but there still is lenders out there. There's still money looking to be placed. And I think that there's a big difference between the last disruption and this disruption, and the fact that this is not a financial disruption. It's a financial systems situation. This is a society issue that we're dealing with COVID.
Brian, were you going to say something there?
Yeah, look, just the one thing I want to add to that. I know, Aaron, I think it was Aaron who previously may have said, we'll see some of the development has cooled down, but it's interesting. We've had in the past 8 weeks, I'd say at least almost 100 development sites. I mean, some of those are different developers, all have developments in the works, trying to find LP money to get their developments going, because their current investors have run for the hills a bit, but they're still trying to move those developments along. And there is still, many overly supplied markets, and the fact that there's still developers really pushing forward, I think is still a little bit scary.
I'd like to go back to Ben's point about this not being a financial crisis. I think it's an economic crisis, but it's not a financial crisis, in that the credit markets are still functioning, and that that's a major difference with in comparison to the great financial crisis. And I think the other one is the maturity of our sector, and that in the time between the great financial crisis and this crisis hit, self-storage hit its stride and became so much more widely accepted and so much more the target of both public and private capital. And I think those two factors, I think, are driving the durability of our transaction markets at a time of terrific societal dislocation. That was not a question, just commentary. But I will move on to a question, which is directed to anyone who wishes to answer, which is a universe of 4 people who have access to a microphone right now. What has the COVID crisis done to the development cycle? Has it accelerated the end of the current boom, or is it just a pause?
I mean, I'll take a whack at it. I think it's more of a pause, simply because, to Brian's point, have you ever met a developer that didn't want to build a deal? It's all about the capital, and you're seeing a transition from some of the older, more established storage development capital probably wane a little bit. And then I think you see some of the newer capital that's seeing how the product type performs once in, looks at the acquisition environment, realizes they can't hit their return targets and hit any sort of waterfalls by buying high 4s and low 5 cap rate deals. So, what do? Well, you develop your way into a return. So I think it's only a matter of time before some of this new capital figures out that they can't hit some of their return targets by being at least entirely acquisitive on an existing cash flow basis, and they will probably go support some deals that some should be built, some shouldn't be built. But the shortest memories of all are developers. So sorry to all our developer friends listening. It won't be long before I think we'll see some markets. I do think you're going to find places like Portland and Denver, the Carolinas, North Dallas. It will take longer for the memories to fade, but the development still produces the best returns if it's a deal that should be built. And there's plenty of deals that should be built. I'm not saying that development deals shouldn't happen at all. So I think it's just a matter of time before you'll see a return to new supply. But let's hope it's in the right places. I do think this development cycle was had a little more intellect behind it than the last one. So maybe this one will be even better too.
I agree with Aaron. One thing that I'll comment on is we've sold some development sites recently, but the one thing that seems to be more challenging is construction financing seems to be tightening, and I think it will pause the development that for I don't know if it's 6 months, 12 months, 24 months, but I do think we'll see a meaningful slowdown. And quite frankly, we saw that coming probably before this whole disruption. So I don't think it's anything out of the norm, but I think that the new development will be slower in coming, but I think that was coming. And I think the COVID disruption maybe just, stopped it a little bit sooner and made it, probably for the better in most markets. Like Aaron said, there's plenty of deals that should be built, but Denver, Portland, North Dallas, all the ones that everybody knows and talks about, I think those deals are getting harder and harder to finance, which I think will help, some deals that shouldn't be built, not be built.
Consistent with what Aaron was saying about developers having short memories, I have a theory that there's only two true constraints to development. One is capital availability, which I think we can agree is on something of a pause for development, and the other is zoning. And absent those constraints, anything and everything is going to be built. I don't think developers have a lot of, I don't think market studies mean that much. I think if the development function is not being stopped by those constraints, I think it's going to proceed pretty robustly. And moving on to the lightning round.
Well, David, just one.
Go ahead, Brian.
I was going to just say one thing. You're going to have a lot of there are going to be a lot of empty boxes to fill. Especially after this recession, really takes hold with the JCPenney's, the Pier 1 imports, all the different retailers that are going out of business. Eventually, those towns, they may want to halt self-storage from zoning, but they are eventually going to need the tax rolls. And, self-storage, a lot of people have been converting big boxes, and I don't think that'll abate anytime soon. And I think those municipalities are going to want somebody in there.
I agree that the big boxes are going to be ripe for redevelopment to storage, and that kind of flooding of supply is not good. For lightning round, are cap rates rising or falling or neither? Starting with Ben.
They're flat. I think they're flat right now.
Aaron?
Range bound within 20 bips of where we are now.
Scott?
Flat, depending on debt markets.
Brian, that leaves you. Brian?
I think they're flat. I think there was you have the debt markets, with spreads widening on the one hand, but then you have the show that this was a resilient, fairly resilient business. So I think the two balance each other off.
Okay, I'll come back to more lightning round questions later when we're done with the substance of the panel. For now, I'm moving on to Scott's favorite topic of underwriting. Tell me about real estate taxes. I think it's a pretty well-known characteristic of the current crisis that state and local budgets are getting hammered, and at the same time that their tax revenues are down. And they're going to be looking to make up for lost revenue. And I'm wondering, Scott, if that affects your underwriting as you're looking at prospective acquisitions.
Short answer is yes. I mean, I look at real estate taxes with the same disdain I looked at them at, with pre-COVID. We saw taxes growing at a larger pace than the rest of the expense line of our P&L. For the most part, we were able to keep all those in check. I don't think that we're going to see any type of deviation from that from municipalities, I think it's going to continue, or if not get even stronger than that. When you think about the run of success that we had in the industry, municipalities saw it as well. David, to your point, they've been certainly taking, giving a lot, I guess you could say, to all of their local constituents in order to try and fund everything. And now they're going to need to get that money back somehow. And I think when you're looking at a tax roll and you're comparing an active self-storage facility that's been there for 10 years versus a vacant big box or a vacant shopping mall or a restaurant on a pad site that can only operate at 50% due to restrictions, I mean, who are you going to be able to tax harder than that? So I don't think it's going to be getting, I don't think it's going to be getting any better. And we're trying to prepare ourselves as best we can for it. But we factor in, real growth based upon historical trends and probably an expectation that they're going to continue at that level, if not grow a little bit on a go forward.
Anybody else want to jump in on that topic of real estate taxes? Okay.
Well, I'll just speak quick, on, some of your major markets, and obviously during COVID, your biggest markets, your biggest cities have gotten hit the worst. And you take New York City, for instance, we're looking at new construction deals, and, we're looking at lease-up projects that are for sale quietly, or bridge lenders that we've been discussing with on some of the new developments. And you start thinking about New York City and, the crisis it hit, and you have a lot of facilities that have 20% new stock coming into their 2-mile market. And, real estate taxes in New York are definitely going to go up. I mean, I wouldn't be surprised if we start seeing things like you see in Chicago.
That would be devastating. I think we all know about Cook County. Here's a question for anybody who wants to jump in. Which self-storage markets will experience the most volatility over the next 24 months, in your opinion? Top 25 MSAs, other urban, suburban, secondary, tertiary, rural?
The markets with sustained job losses. I think that's the key pivot point.
I agree with Aaron. The job losses are a big deal, but interestingly enough, we sell a lot of secondary and tertiary market deals, and conversely, on our management platform, we manage a lot of those secondary market deals. And shockingly, the urban deals that we run in Phoenix, Denver, Sacramento have been much more affected by the COVID disruption than the secondary and tertiary markets. Our secondary and tertiary market deals are outperforming the major market deals by a large factor right now. Over the last 90 days, I just don't see those smaller markets that they haven't seen as nearly as much new supply added, and that they're just outperforming. I don't think the COVID disruption has been as big of an effect on them. There's also this cultural difference, I think, in the smaller markets than the major markets, and the fact that if you live in Carlsbad, New Mexico, or Las Cruces, New Mexico, you're not nearly as affected as if you live in Denver or New York City or something like that. So that's what we've seen, across our stuff, is that the secondary markets are much more robust right now than the major markets.
I think a lot of the secondary markets it's like what COVID.
Totally agree.
Some of the restaurants, there was nobody enforcing anything, so the restaurants weren't closing. The mobility was still there. I think that's why we're so pegged to unemployment. If you see, because to everybody's point, this was really, somebody turned our economy off like a light switch in one day, and you just can't prepare for that. I think if you begin to see sustained job losses and see real economic deterioration, that's something you can. All the stimulus in the world won't fix that. So I think the secondary markets outperformed over the last couple of years because they haven't had as much new supply, and they also outperformed over the last 4 months because they haven't had as much restriction. They were much less affected. I think at the end of the day, what the whole recovery hinges on, we're not going to stay at 24, 25 million unemployed, but are we going to get back to 3 or 3.5 million unemployed? I think the real impact is where somewhere between 4.5 million and 9 million people probably remain longer term unemployed, not by choice. How close you are to the 4.5 versus how close you are to the 9 is going to completely drive the outcome, I think.
I would argue you could also add that shorter term, part of it's going to just follow where the virus spikes, right? I mean, so you saw in the Northeast, it spiked bad and everything got shut down, and you saw some additional pain there when you compare it to, I'll pick a market like Phoenix, where we're seeing pain in New York and Phoenix looked pretty good. And now all of a sudden we're seeing a spike in the virus in Phoenix, and I think it's to be determined what potential impact that's going to have operationally in those markets. So I think that, not to get political, but ability to be able to control the virus, control the spread, and eventually have a vaccine, which Fauci's pounding the table on, is going to happen eventually. I think that's going to be a lot of it, probably, David, at least in my opinion, the next, more short term, 6 to 9 months, maybe.
Scott, I think you hit the nail on the head there. I think that it's really a tale of two stories. The gateway cities that were affected early, certainly have had a much tougher go. And quite frankly, the deals that we've marketed in those markets are much harder to sell than, the deals that are, say, Texas or Florida, where there's been less disruption or less, social angst about it.
Well, up until now.
Yeah.
So
Go ahead, Brian.
So I only got bits and pieces, but I feel like I think I got the general sense of what everyone was saying. But one thing I may disagree a little bit about, where COVID moves and if those markets are volatile or get affected. I don't think that is the biggest factor. I think the factor is really what happens with the economy. And I think, we can all probably agree that, we're seeing a V-shaped, we're seeing a bounce back, but that's really because of the fact that we have $3 trillion pumped into the system, and 500 billion of that is for PPP. And that ends in December. And when all of these restaurants that were operating at 50% and probably in December can only operate at 60, 70%, I still think you have an unemployment that is going to be pretty high. And that's, that will have a factor on not as much the stable properties, but the lease up properties will struggle as they did in the last recession when unemployment ticks up. And I think you're going to see the new norm of unemployment be a real factor next year.
Yes, I think it'll be interesting to see what changes in the marketplace are for the moment with this crisis, and what are the structural changes that we're going to be living with indefinitely. So we have just less than 5 minutes. What I'd like to do is encourage any of the audience to submit questions online, and we can address them as quickly as possible. And meanwhile, I'm going back to the lightning round. And the next question is, what was the last time before this afternoon that you wore a button-down shirt? Starting with you, Ben.
It's been a couple of weeks, I'm not going to lie.
Okay. Aaron?
Well, the buttons didn't go all the way down, but it was Monday, so that I could go play 18 holes of golf.
Scott?
Yeah, full button down, 97 days.
Welcome back. Welcome back.
Good to be here.
Stand up, Scott.
Yeah.
That's the next round, Aaron. That's the next round.
Do you have sweatpants on, Scott?
We'll go with that, sure. Go ahead, Brian, you're up.
I guess.
I have no idea what the question is. I'm just asking something.
Okay. Well, why don't you supply the answer and we'll play it as if it were Jeopardy.
I heard something about Aaron playing golf. So I'm guessing it's like, what have you missed doing? And I'd say just going to a bar and having drinks with friends, but maybe I'm wrong.
We'll accept that. We'll accept that answer. I see no more questions coming in on the feed. And with that, we're going to stay away with what pants people may be wearing. And I want to really thank you guys all for your thoughtful answers and participation. In the new world that we're living with, at least temporarily, these types of discussions are extremely valuable, I think, to each of us and to those who are watching in the audience. and help make up as best we can for the void of not being able to get together in the trade show environment that I think that we all enjoy and that we all benefit from. So once again, I'd like to tip my hat to my colleagues at SBOA and List Self Storage for putting this together, and for the opportunity for all of us to discuss trends in acquisitions and self-storage. So thank you all very much for joining, and we'll see you on the trade show floor when that opens shortly. Cheers.